Hello, Neil Wilding here. I want to welcome you to another Stonewood study group. As you know, we use this format to keep our members updated on all sorts of things. Last month we talked about automated webinars. This week, what we thought we'd do is give you a peek into a presentation that I'm actually going to be giving next week at NAFA. We have a new partnership with NAFA. They've asked us to be a part of the agenda they have for their conference next week in DC. And we're going to have a good 2-3 hours of the agenda. And so what I thought I would do, though, I started putting together a new presentation for it. And I thought, you know what, it would really be great for our members to see this. So you're going to get a little sneak preview. It's basically the presentation I've given at Innovate, where we take concepts of, like we take an IRA and we're going to compare the income we could get if we converted that to Roth. Or if we did a conversion into life insurance using IUL, but I've expanded it a little bit to include annuities and the combination of life insurance and annuities, just so we could see a lot of different options. And as I put the presentation together, I thought, wow, this is a really compelling message. And I thought it'd be good for us to bring that to our membership base in the study group. So I'm not going to be able to take questions during this. So if you have questions, just jot them down, shoot a note to the member success team, or just shoot a note to me directly. We'll get your questions answered. I am warn you, it is slide heavy because I like to, as I'm kind of want to do, I'm going to dive into the numbers a little bit, and so we're going to be jumping around. So if I lose you in the process, certainly take note, shoot me a note, and we'll get your questions answered. So this presentation, as I mentioned, it's a normally, and when we deliver this live for the NAFA audience in DC, it's going to be 2.5 hours or so. I'm going to condense that, and I want to just kind of get to a good like 20-30 minutes of the income part of this. So when I hit next and I'm starting on step 2, that's because we're kind of jumping into the middle here. This is not a Quentin Tarantino film where we're jumping timelines here. We're actually going to skip right to step 2 here, which is the meat and potatoes of this presentation. And so what I'm going to do is I'm going to look at the income projections from someone that would just stay in an IRA and continue to defer taxes to the future until they start to take income, and they would just take a systematic withdrawal from their managed account, mutual fund portfolio, whatever that may be. And then I'm going to compare that to what the income would be if we just stayed in that portfolio but converted those assets to Roth, and see what that income would look like. And then we're going to compare that to where in the Roth, if instead of just using the existing portfolio, what if we put that into an FIA with a guaranteed income rider? What would that income plan look like? And then we're going to compare that to, well, not everybody needs an income focus. What if it's more of a legacy focus? What would it look like if we used IUL? And then the final piece of this will be some sort of comparison or a combination of IUL and annuity. And so that is going to be the exercise here going forward. As always, when I'm in Innovate, or whether I'm even doing a one-on-one coaching call with any of you, and we start to dive into the reports, the most important thing before we look into the reports is we look at the assumptions. We have to make sure we're using realistic, reasonable assumptions. And if you've been to Innovate, I kind of get up on my soapbox a little bit here. I'm not going to go that far up, but I am going to at least kind of talk through some of the assumptions that I'm using here so that we can compare income. With assumptions, to me, two key things here. We are looking at the after-tax income and total wealth that you can generate from this pool of assets. So of course, tax rates are a key assumption. And then the second is growth rate. We're looking at comparing very different financial instruments. So it's important to talk through what assumptions we're using for those. So let's start with tax rates. I like to look at a 30% increase in rates. So in my effective tax rate, normally if we're going to start at say a 20% rate, which that could be on the high end here, because again, we're not talking about tax bracket here. We're talking effective tax rate. It could be on the high end, whatever assumptions you want to use, you use. I use 20 just because it's round and it's nice. And there are many clients that we work with certainly have a 20% effective tax rate. But the key here is to show an increase in those taxes. The reason to do this plan is because we have a risk that we have identified for our clients that taxes could be higher in the future for our clients. We are not saying that they will be higher. We are saying they could be higher. Just like when we're investing in the market could go down. You know what? Normally it goes up, but it could go down. And because it could go down, we have to use asset allocation and manage the efficient frontier effectively for our clients, right? Because the market could go down. Well, taxes could go up, and so we have to mitigate against that risk. And so I like to show a 20% tax rate increasing to 26. Come to Innovate if you want to see all of the methodology behind why we use 30%. It's basically taxes normalizing to where they were just 2 short decades ago. And just a point here, and the reason I bring this up, we get a peek into all of the reports that our members use. And one of the most common mistakes I see is that people will go in and they'll run the total tax burden report, or they'll run our income reports, and they'll just plug in a 20% tax rate and leave it there. And that's only half the story. If we believe taxes could be higher in the future, we have to model that. And so here's what I mean. I'm just going to go through. This is not really the income example here. I just want to talk through why we need to show tax changes in our assumptions here. If we just have an IRA, and let's say it's a 60-year-old for every $100,000 in their IRA, by the time they reach age 70, I don't even remember what growth rate I used here. It's a neutral point because I'm going to use the same growth rate throughout. But 100,000 has grown to 179,000 by the time we reach age 70. Well, when we trigger income for that IRA, if I'm just going to take a systematic withdrawal and make it last age 100, based on the assumptions I have here, that's a $12,000 distribution. But see, with an IRA, that's pre-tax, right? So the total amount that they would have in their pockets would be just shy of $10,000 a year. And so over 30 years, that's about, and of course we're rounding here, but that's about $300,000. Well, that's the IRA. Now, if we go Roth, what you're going to see here is a different path to the same number. If we convert that 100,000 to Roth, now we're at 80,000. And then with that growth, the 80 becomes 143,000. But now with a Roth, when we trigger income, everything we get is tax-free. That number is, guess what? Just short of $10,000. It's that same total $300,000 total income. Now, why is that? Like, are you telling me we should still convert to Roth? Yes. Here's why. Because I assumed the level taxes and the same growth rate. So if you don't change the tax assumptions, and you don't change the growth assumptions, then an IRA and a Roth are going to be the exact same number. It is a different path to the exact same income. Well, why do it? Well, the reason we do it is that taxes might change, right? And so we need to plug that assumption into the reports here, because then if we go Roth, right, that 80,000, you see the exact same numbers, even though that I modeled a tax increase in these next numbers, where 20 going to 26. The 80 still goes to 143. You still get 97, which is basically $300,000 total. That's the same because we paid the taxes before the tax changes incurred, right? So no change. Well, the difference happens in the IRA, right? And we've got $100,000 of pre-tax money that grows to 179, and the $12,000 income number still the same. But when does it differ? When you pay the taxes. Because if we assume a tax increase, that's when these assets in the IRA would still be subject to those changes. And so what you have here is less money, right? And this is tax risk rearing its ugly head. And now you might say, well, that's not so ugly, 300,000 versus 277. But you see, that represents a 7% loss. And we need to start thinking about taxes the same way we think about the market. Imagine if we came to our clients and said, hey, I've got this great investment idea, and no big deal, we're just going to lose 7%. Right? Nobody, would sign up for that. Yet when we continue to defer taxes into the future, we're signing up for that. And so this is just putting some numbers to tax and legislative risk. Now, this is kind of, I just did this generic example because I wanted you to if you take away anything from this, when you run your Stonewood reports, make sure you model those tax increases. So now let's get a little more detailed. And look at our assumptions on the growth rate side. And this is all the homework we're doing before we even get to looking at the income we can get from these various financial instruments. So now with growth rates, right? And what we're thinking about here really is like a couple of different scenarios. One scenario is just staying in the IRA, and in that case, the financial instrument is going to be a brokerage account, a managed account, mutual fund, or whatnot. And then we're looking at converting to tax-free. And some of those tax-free options we're going to be changing, not from being in a brokerage account, but being now into an annuity or life insurance. And so obviously very different financial instruments. And so what growth assumptions are we going to use if we just stay in that brokerage account? Well, you have to think about how these financial instruments mitigate risk. For example, in a brokerage account or a managed portfolio, even mutual funds, whatever it is, managed ETF portfolio, how does that account or how does an advisor mitigate market risk in that type of account? It's through allocation. So that means that if we're going to lean on history as our guide, if the S&P has done 7% since the turn of the century, that doesn't mean our clients get a 7% return, because we have to mitigate against the risk that that market could be less or could go down, which means that only half of our assets are participating in that nice growth rate. The other half are in a more moderate, fixed income bucket. So when we're projecting forward and we believe that the market's going to do 7 or 8%, that could very well be true, but that's the stock market. If we're mitigating risk through allocation, which retirement assets need to be, the blended rate is really the more applicable number here. Now, when we're in an index product, when we're going to convert to tax-free, regardless of whether we're using annuities or life insurance, we mitigate risk through innovation, through product design, and through the power of indexing. So we don't have that same type of diversification issues here. We can stick to an index, use that index, regardless of how old our client is or grows to be, because worst we can do here with the indexing concept is zero. And so whatever growth rate we apply to that financial instrument, all of the account is going to participate in that. And that fundamental difference leads to a lot of the differences in the results you're going to see as we go to project out potential income. All right, so now we get to the fun part here. So let's take each one of these instruments based on the assumptions that I just kind of went through. And we're going to start with a traditional IRA. So this would be an account that's in a brokerage account, mutual fund wrap, individual balanced mutual funds, whatever it may be. And it's worth $500,000 today, and it's going to grow to let's just say by the time we reach age 70, it'll grow to 874 based on these assumptions. But see, the challenge is the 874, even though the fees are shown on that screen, they actually weren't reflected. The 874 is before fees. The 758 is after fees. So already our retirement assets are under attack by management fees. The average cost of a managed portfolio is actually over 2%, because you've got the advisory fee, a third-party asset manager. I'm not saying managed money is bad. I have managed money. I'm just saying that nobody does it for free. So we have to model in those expenses. And so now you got 758. And so 758, if we were to just say, okay, what kind of systematic withdrawal could we take from that IRA to make it last age 95? The answer is $46,000. So you could take out 46 grand, make it last all the way to age 100 from that traditional IRA. Yeah, but I didn't model taxes. And so then when you apply a tax rate, Suddenly that 46 drops to 37. Our retirement assets are under attack by managed account fees and by taxes. Oh, wait, I just modeled that to stay the same. So now when we start to model tax increases, like I'm encouraging you to do, that 37 drops to 35. And then if taxes come in and change again, from 35 down to 34. And then notice I modeled an 8% growth rate. The S&P 500 has only done 7.03. So what if the half of the assets, instead of getting 8, only gets 7.03? Well, now the 34 becomes 31. And actually in my trainings, I've done this before. Maybe you've seen me do this exercise before. I took it a step further because on the other side, notice I put the fixed income. That's the other half of the assets. I assumed 3.5%. Anyone know what 10-year treasuries would have delivered? And I know not everybody's buying 10-year treasuries, but it is kind of a good benchmark for the fixed income side of the equation. If you were in 10-year treasuries since the turn of the century, the same time frame we calculated that 7.03, that number would actually only be 3.25%. So retirement assets are under attack. We started with $500,000 that grew to 874,000. But then when you got fees in there, it knocks it down. And then when you start projecting income, you got to model taxes. And then you got to model more taxes. And then maybe you got the stock market taking chunks at you. And then fixed income or interest rate environment is impacting you. Suddenly, you can very quickly see all of the various things that could happen, all the variables that are in play for our clients when in a traditional IRA. So that is, I want to just go through that exercise so you can just kind of see, systematically how that, like, different kind of deductions, if you will, from what we thought might happen with our traditional IRA. So now let's look at it, and notice I changed a number there. And this is where I might lose you, so work with me here. But I wanted to be, anytime I do this exercise, I want it to be unassailable. And I want to make sure to bring every detail possible I can in here, to where someone might have an objection and say, yeah, but, well, this is one of the buts, and I'm just going to address it. Notice the 500 jumps to 509. What we did here is, in my assumptions, I'm assuming that taxes go up here in the next few years. I know that Trump's been out there saying, maybe he would like to keep the tax policy that he put forth before. He'd like to extend those, but there's still a chance that those are sunset. So I'm going to just assume that we sunset that tax law at that time, which means that during a 5-year conversion period, you're going to pay a little bit more tax than just the 20%. So what I could do there is I could just take, if we're going to convert $500,000 and we pay a 20% tax, that's 400,000. So I could just model like a little less, like 380, 390. But instead, what I did was I assumed all 400,000 for my later comparisons. So that means I'm going to give a little extra credit to the IRA here. If I lost you there, I'll explain it later. But just know that if we're going to build a conversion plan here and taxes change during the conversion, if we're comparing IRA to Roth, you're either going to have less Roth or more IRA. I just chose to show more IRA. So in this example, and that way it's pure apples to apples. The income that we can generate is the exact match of what it should be. All right, so here we are with that traditional IRA, starting with 509. The income you can generate there, $42,000. Again, oops, forgot the model taxes. That number is more like 31,000. So total benefit is $811,000 that our client could experience. Again, that's starting at age 70 and assuming they pass away at age 95. So that's our traditional IRA number, 31,000 after taxes, total benefit 812. Now let's start changing things. Let's look at a Roth. Now I'm going to assume all 400,000 make it to the Roth in the conversion process. Example 1 is just keeping those assets in that same managed portfolio that it would have been in the traditional IRA. So we convert from traditional IRA to Roth. We have $400,000 now of tax-free assets, and we're just going to continue to grow in the same portfolio that we had before. So now you're 400,000. The income that you could take there, again, this is after tax in a Roth, it's all tax free. So that 33,000 you get to keep. Total benefit $857,000. So congratulations, you were better off in the Roth. Why? Well, because I modeled tax changes, and I modeled multiple tax changes. I modeled taxes going from 20 to 23 to 26. So if we're in a traditional IRA, all of our distributions are subject to that highest rate that I modeled. With a Roth, most of our taxes are being paid before those tax changes happened. And even the ones that are modeled happened, like not the entire assumption. I modeled 20 to 23 to 26. So congratulations, the Roth wins. But now is where I want to start thinking more. What if we just did a Roth conversion, but instead of keeping that money in the same managed portfolio, what if we used the good old-fashioned annuity? And what if we used an FIA with a guaranteed income rider? So and here at Stonewood, I know we've always been promoted and we love tax-free IUL, and we have models for IUL. Last year, we introduced Annuity Alpha. So we started talking more and more about annuities. So I called up my good friend Jay Rosenkrantz from Athene. I said, Jay, hey, run me an illustration on your most popular product where we're using an income rider. And he did. And so again, this is a Roth conversion here. So we're basically assuming that the 500,000 is converted to 400,000, and we've bought a Roth FIA. So that means that the guaranteed income that we can generate is all tax-free. And that illustration he sent me told me that if we bought at age 60 and triggered a guaranteed income rider at age 70, we would have a $58,000 a year guarantee. Total benefit if we live to age 95 of $1.4 million. That's a staggering number. And when you look at the difference, it is a staggering difference. Now, I know what you're thinking. Like, if you just look at that number, oh my gosh, why wouldn't everybody just do FIAs with guaranteed income riders? And by the way, they probably should for a piece of their money, because it is one of the most powerful financial instruments. Now, the real cost here of the annuity is control, right? Now, so we are giving up some control here because we're triggering a guaranteed income rider. But boy, that 58,000 is sure nice. And if you're thinking like, wow, how nice is it really? Well, that's what the Annuity Alpha software does. So I'm just going to show you here, and I'm going to use my Annuity Alpha software to do this little exercise just to see how good of a deal that $58,000 guaranteed income amount from Athene is. What if we just tried to match the income from from a managed portfolio? We're trying to match the guarantee, right? So the annuity is guaranteeing 58. If you're just in a brokerage account, and you can take whatever distribution you want. There's nothing limiting you there. So you can certainly take out $58,000 here, but what are you sacrificing there? You're sacrificing longevity, right? And in fact, based on the assumptions that we've been talking about here, if you tried to stress a brokerage account by taking a $58,000 distribution, you'd be out of money by age 80. You wouldn't even make it to life expectancy. So that's one thing. Now, what if we switch what we're focusing on here, and what if we just tried to match the longevity? I assumed that in this scenario, we assumed the client passed away at age 95. So what if we just wanted the brokerage account to make it to 95? Well, you could, but you'd have to take a pay cut to the tune of 32 grand. So you could take 32 grand out a year and make it last to 95. But again, the annuity is guaranteeing 58. So then the question becomes, and this is to me the most powerful part of our Annuity Alpha software, it says, well, what would the capital markets have to do to just match that $58,000 guarantee all the way to age 95? And the answer is a blended, keyword blended, rate of 8.15%, meaning, yes, you know what, you could actually deliver that $58,000 after tax, or tax-free income, but you would have to expect a blended portfolio to get 8.15%. Now you might think, well, stock markets, it's I know over the last since the turn of the century, it's only been 7, but you look back, maybe you could get think about an 8% number. But see, keyword blended. If half of our assets are on the fixed side of things, then that means that we're looking at a 13% need just from the equity part of the allocation. And that's just getting you to what the annuity guarantees. It's just matching it. So I took this little sidebar, so just so you could say, wow, it puts some financial muscle, some real numbers behind an annuity guarantee. Now, I know those numbers are overwhelming, but there's still yeah, but I got to annuitize that thing to get that income rider. And I know what you're thinking. And I don't know that I want all of my clients' assets to be tied to this income rider. Or maybe you're thinking like, well, wait a minute, what if the client doesn't need that income? I'm not going to trigger an income rider for a client that doesn't need the income. Well, let's look at another tax-free option. Let's look at IUL. And I used a carrier with a 5.97% illustrated rate here. I know those things change all the time. But in that scenario, if you just put $400,000 into an IUL policy, and again, remember with IUL, it's kind of like a brokerage account. You could take whatever you want. But if you want to make it last, the illustration will tell you a certain amount. But if I was focused on income, maybe I'd go the annuity route. So maybe this client here in this example, we're not really focused on income. We're not trying to maximize income. We just need some. And so in here, I just took 30,000. I think in this illustration, you probably take almost 40, but I'm going to just take 30. And the reason for that is you've got $750,000 worth of income, but there's a $1.1 million death benefit left over for the heirs. So your total wealth in this example is a whopping $1.9 million. So look at what we're doing here, right? So we started with this IRA and we could just stay and continue to do what we're doing and get about 31 grand a year, make it last, total benefit of 812. We can convert to Roth, but just kind of stay in the same managed portfolio. And you see some modest improvements because we hedge the tax risk there. But then you see with the annuity, if you've got an income focus, well, you can blow that number out of the water when it comes to income because we can guarantee that income for life, right? And you'd have in this example a $1.4 million total benefit because the client lived to 95. Or we could go with like a more of a estate planning wealth transfer model for assets that are not with the IRA or not necessarily needed for income. You could still take some tax-free income, 30 grand, but leave most of that money in there for our heirs, where the total benefit is 1.9. Pretty amazing, huh? So maybe you can see where I'm going next. Like maybe we just kind of split it up and do a little bit of each. What if we just went with the Roth FIA for half the assets, IUL for the other half of the assets, and you got a total of 400 grand? Um, and so so now I'm just taking the results and cutting them half, right? So the guaranteed income from the annuity in this case would be 29 grand. The policy loans that you're taking from the IUL is 15 grand. Total benefit or total income from the two combined strategies is 44 grand. And so here you're looking at 1.1 million of total income plus another almost $600,000 in legacy from that life insurance policy. And so now let's kind of look at what we're doing here. Those are your choices. And so to me, this is like two financial instruments coming together to just work in perfect harmony because you got half of the assets working for the income. And not only is it guaranteed to 95, it's guaranteed to life, right? But you're also kind of hedging your bets with the life insurance and IUL, where a portion of that income is still available tax-free, but you also have the life insurance component. And you have some flexibility there. You can also, kind of be smart about the distributions you take each year. Take a little bit more here or there based on how things are going. I think it's a really powerful combination of the two. So, the ultimate goal here, when we're telling this story, is we're looking to build results and have a truly diversified portfolio. Not only diversify our clients as it pertains to the market, or as it pertains to income, but really being the advisor in your market that understands and can articulate tax and legislative risk. And then you use the Stonewood reports like I just did to back it up, to show how powerful these plans can be in comparison to just sitting there doing nothing. So I'm going to go ahead and kind of pause things here. That it kind of puts a wrap on this presentation. I think I'm about 30 minutes in, so that's probably enough for this study group. If you have questions, or if you want to see the presentation in its entirety, I'm going to be giving this. I just did the small version of it. I'm going to be giving the full thing at NAFA on Monday, but I'm also going to be incorporating this into our Digital Innovate session. So register for Digital Innovate. It's the first part of June. What we're doing for that, it's 3 sessions of 2 hours a day. We're going to have a tax day. We're going to have an annuity day, and we're going to have an estate planning and other marketing concepts day. And so what I encourage you to do is have your whole staff sign up for that. As a Stonewood member, everyone should see at least a portion of the training that we're doing. Register for it. I know it's a lot to ask for 6 hours to sit in front of a computer screen, but register for it even if you can't make it, because that way you get the recordings and you'll be able to watch it at your leisure. Now, if you want to come see us live, the next Innovate Summit is going to be in Louisville in middle of September. Both of those registration links are live. So the virtual Innovate in June, the live event in September. I highly recommend you knock them both out because we would love to have you. So if you have any questions about all this stuff, like I said, shoot me a note. I love to have conversations with our members. But again, I thank all of you for being loyal Stonewood members. Without you, we have no company. And so it's been a pleasure getting to know so many of you. And hopefully you took something away from this one. So thanks and have a great day.